Every commodity crisis follows the same mathematical progression. First, demand growth exceeds supply growth. Above-ground inventories bridge the gap without obvious disruption. Then, inventory drawdowns accelerate as the gap widens. Market participants assume normal supply-demand relationships will restore balance through price adjustments. Finally, inventory depletion reaches critical levels where price mechanisms become inadequate to resolve physical scarcity. The market transitions from gradual repricing to explosive shortage dynamics. The silver market has just entered this final phase. The mathematical inevitability of what comes next should terrify anyone holding paper silver promises, while inspiring anyone positioned in physical metal. We're not approaching a silver shortage. We're already in one. The shortage has been masked by inventory liquidation and export manipulation for 5 consecutive years. But those mechanisms are exhausted. What's coming in 2026 isn't market volatility. It's the explosive repricing that occurs when physical reality overwhelms financial engineering. Today, we'll examine evidence showing silver shortage conditions have reached critical mass, why traditional supply-demand mechanisms can no longer function, and why the price explosion ahead will be unprecedented. To understand why silver's price explosion is mathematically inevitable, we need to examine structural imbalances. These have been building for years while market participants focused on short-term trading dynamics rather than physical fundamentals. For 5 consecutive years, global demand has exceeded total supply, creating a structural deficit. This has quietly eroded inventories across the world. In 2025, global silver demand reached 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces. This represents a deficit of over 230 million ounces in 2025 alone, equivalent to Mexico's entire annual output. This deficit didn't occur in isolation. It represents an accelerating trend-building momentum since 2021. The accumulated deficit between 2021 and 2025 is estimated at about 900 million ounces. This continues to pressure known above-ground stocks held in identifiable bullion inventories. 900 million ounces represents more than an entire year of global mine production. This cumulative deficit has been filled by drawing down above-ground inventories from exchange warehouses, bank vaults, and private holdings. But those inventories are approaching depletion. From 2026 onward, structural shortages are evolving into an overt supply crisis, a crisis that can no longer be masked. The supply side of silver's equation faces constraints that make rapid production increases mathematically impossible, regardless of price levels. Silver mine output peaked in 2016 with approximately 900 MAs, falling to an estimated 835 MAs in 2025. This production decline isn't temporary or cyclical. It reflects structural changes in mining economics and ore quality, changes that cannot be reversed quickly. Unlike gold, silver mining is largely a byproduct of other metal production, primarily copper, zinc, and lead. This means even if silver prices double, miners cannot easily increase supply, because their operations are driven by base metal economics. Approximately 70% of silver production comes as a byproduct. This means silver supply decisions are made based on copper, zinc, and lead economics rather than silver prices. When silver hits $100 or $150 per ounce, it doesn't automatically trigger new silver mine development, because the economics of base metal operations remain the primary consideration. Adding to the problem, new mining projects take 8 to 12 years to develop, and ore grades are declining globally, even if mining companies decided to develop new silver-focused operations. The timeline for bringing new supply online extends 8 to 12 years into the future. Meanwhile, demand growth and inventory depletion operate on timelines measured in months and quarters. The China factor: export restrictions. China's strategic decision to restrict silver exports has removed the largest source of refined silver from global markets precisely when shortage conditions were reaching critical levels. Starting January 1st, 2026, China is implementing new export restrictions on refined silver. These are already sending shockwaves through global markets. Only large, state-approved companies will be allowed to export, and only after obtaining special government licenses. China doesn't just mine silver. They refine and process silver from concentrate imported from around the world before re-exporting it as finished product. Their export restrictions affect approximately 60-70% of refined silver that has historically flowed to Western markets. This timing is particularly devastating because China's export restrictions are eliminating supply at the exact moment when structural deficits were already overwhelming available inventories. The combination of existing deficits plus Chinese supply elimination creates shortage conditions that exceed what global markets can accommodate through any conceivable supply alternatives. Inventory depletion, the warning system. Screaming, the most visible evidence of impending supply crisis, appears in inventory data from major exchanges and storage facilities worldwide. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association, LBMA vaults, have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. But the COMEX situation is particularly alarming because it reveals how paper markets are approaching delivery failure conditions. Since 2020, registered silver inventory, metal immediately eligible for delivery, has shrunk by roughly 75%, currently hovering around 82 million ounces. Meanwhile, open interest in the March 2026 contract remains between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 million to 455 million ounces. The mathematics are undeniable. COMEX has delivery obligations of 455 million ounces, yet registered inventory stands at a mere 82 million ounces, a significant deficit. Even with a conservative 20% demand for physical delivery, COMEX lacks sufficient metal. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. Industrial users face 8 to 12-year development timelines for new sources, while operating on thin supply cushions. This makes a supply crisis a mathematical certainty, not just a theoretical possibility. While supply declines, demand is accelerating across multiple industrial categories. These industries cannot substitute alternative materials for silver's unique properties. Crucially, 3 drivers, nuclear, AI, and solar, reinforce each other, creating compounding demand. AI needs power, increasingly from nuclear baseload and massive solar farms. Solar manufacturing consumes silver, and reactor control rods also require silver. AI data centers demand massive energy infrastructure, driving nuclear power development. This requires silver for reactor control systems and advanced semiconductors with silver-based components. The energy systems powering AI depend on solar arrays that consume silver in photovoltaic cells. The AI boom alone represents demand categories that didn't exist 5 years ago. These new demands now consume massive quantities of silver for components that cannot function with substitutes. This demand has been badly undercounted in earlier silver market forecasts. Why? For 2 decades, nuclear projects moved slowly, with approvals taking 10 years or more. Analysts focused on PV, autos, and electronics, rarely isolating nuclear reactor-related silver demand. They didn't see it as a variable capable of explosive growth. But times have changed. Nuclear power development is accelerating globally as governments recognize AI infrastructure needs. Nuclear is key. This creates massive and completely inelastic silver demand. Nuclear reactor safety systems cannot operate with substitute materials, regardless of silver prices. The most convincing evidence of impending crisis appears in physical premium data. It shows paper and physical markets operating in completely different realities. In Japan, premiums on platforms like Mercari have surged to around 60%. This reflects intense retail demand amid limited availability. In the UAE, particularly Dubai, premiums are currently around 40%, driven by investment demand, jewelry consumption, and the region's role as a physical bullion hub. When physical silver trades at 40-60% premiums over paper prices, it indicates a disconnect. Paper pricing mechanisms have lost connection with physical reality. These aren't temporary arbitrage opportunities. They're evidence of market structure breakdown. Paper and physical now operate as separate systems. This scarcity drives a massive price divergence between paper-traded silver and the real physical metal. In Shanghai, physical silver trades above $80 per ounce, while COMEX futures remain much lower. This physical paper divergence reveals futures markets are disconnected from actual silver availability. Paper contracts no longer represent claims on real metal. They represent cash settlements. Mainstream analysts who previously dismissed precious metals are now issuing impossible forecasts. A brokerage raised its 2026 silver price estimate by 67% to 75 Oz, and its long-run estimate to $50 Oz. But even these dramatic increases may prove conservative given the severity of supply shortages. Felipe Geisels of BNP Paribas Fortis wouldn't be surprised to see silver well north of $100. Veteran analyst Michael Oliver suggests $100 to $200 silver by early 2026. The looming silver supply crisis is not a distant threat, but a present reality shaping our future. Many now view prices above USD 100 per ounce in 2026 as increasingly plausible. This is due to structural realities, not speculation. These forecasts represent recognition among professional analysts. Normal supply-demand mechanisms cannot resolve current imbalances. Forecasts ranging from $100 to $200 per ounce reflect understanding. Shortage conditions require prices that force demand destruction. The nuclear demand factor, completely inelastic. One of the most underappreciated demand drivers involves nuclear power expansion. This creates silver requirements regardless of price levels. Nuclear reactor control rods require high purity silver for safety systems. They cannot operate with substitute materials. As global nuclear capacity expands for energy security and AI infrastructure, nuclear silver demand becomes a fixed requirement. This creates a floor under silver demand that cannot be reduced through higher prices. Nuclear facilities will pay whatever silver costs. Reactor safety systems are non-negotiable requirements for operations. Over 50 nuclear reactors are under construction globally. AI energy needs drive additional nuclear development. This inelastic demand category continues expanding. Meanwhile, supply becomes more constrained. Beyond industrial acceleration, investment demand has exploded. Sophisticated money recognizes asymmetric return opportunities. Investment demand has also increased sharply, but it differs from industrial demand in important ways. Industrial users consume silver, removing it from circulation permanently. Investment demand can theoretically return silver to markets. However, current shortage conditions suggest investment demand will not provide meaningful supply relief. Investors recognize physical scarcity is structural, not temporary. They hold physical silver through price volatility. This means investment demand reinforces supply tightness rather than alleviating it during shortage conditions. While physical shortages intensify, paper silver markets face a credibility crisis. This threatens their pricing authority. The market has repeatedly exhibited backwardation. Spot prices exceed futures prices, a strong signal of urgent physical demand. The exchange for physical EFP spread has widened to 1.10 per ounce. This shows the paper market is failing. Backwardation and widening EFP spreads indicate market participants prefer physical silver over paper promises. When futures trade at discounts to spot prices, delivery obligations trade below immediate physical availability. This is clear evidence of supply stress. Mathematics is unforgiving. Paper silver in derivative form remains plentiful, but physical silver is growing increasingly scarce. Volatility is not random noise. It is the market's desperate attempt to ration dwindling physical supply. The paper architecture continues pretending abundance exists. The breakdown of paper pricing authority creates new conditions. Physical availability determines value, rather than futures trading or derivative manipulation. Once physical delivery becomes the benchmark for price discovery, traditional futures exchanges may lose control. Similar to what happened in lithium and rare earth markets when physical shortages emerged, silver's transformation from industrial commodity to strategic resource changes demand patterns. Shortage conditions become permanent. Government classifications of silver as strategically important create long-term demand floors, independent of economic cycles. When countries designate silver as critical for national security, they accumulate strategic reserves regardless of price levels. The United States has added silver to its critical minerals list and launched Project Vault to stockpile critical minerals. You don't take such steps when silver is abundant. Strategic resource designation means government demand competes. It competes with industrial and investment demand on a must-have basis, not price-sensitive. This creates additional inelastic demand that cannot be reduced through higher prices. When supply constraints meet inelastic demand across multiple categories, simultaneously, price mechanisms become inadequate. Normal economic relationships break down. Pricing must rise to levels that force demand destruction across applications.